Hello everyone. In this video, I will explain the concept of cash reserve ratio and incremental cash reserve ratio declared by Reserve Bank of India in its monetary policy review conducted on 10th of August 2023. First, let us understand the meaning of the term CRR, that is cash reserve ratio. First, let us understand the meaning of the term cash reserve ratio. In simple words, it's nothing but commercial banks maintain some amount of money as reserve with Reserve Bank of India in terms of cash. It is calculated on the basis of NDTL, that is net demand and time liability. Demand liability for a bank is nothing but the amount of money deposited by the people in the current account and savings account. And time liabilities of the commercial bank are the fixed deposits of the people. These are the examples of demand and time liabilities. Of course, few more items are considered as part of NDTL, but this video will focus mainly on CRR and incremental CRR. Now, when it comes to cash reserve ratio, let's assume that the current CRR is 4.5% and the net demand and time liability of the bank is 100 rupees. Now, 4.5% of 100 rupees comes to 4 rupees and 50 paisa. So commercial banks will keep 4 rupees and 50 paisa with RBI as a type of cash reserve. Basically, assume that it's a type of current account maintained by commercial banks with RBI. And in this case, the maximum amount of loan that can be given by the commercial bank is only 95 rupees and 50 paisa. Here, remember an important point. Commercial banks, when they deposit their money with Reserve Bank of India, they don't earn any interest on that particular amount. Now, it is said that to control inflation, the monetary authorities will always try to reduce the money supply from the economy. In order to reduce the money supply from the economy and to control inflation, RBI, let's assume that revises the CRR to 6%. So now, if the net demand and time liability of a bank is 100 rupees, 6 rupees are maintained by the commercial banks with Reserve Bank of India in the form of say current account, and the commercial banks are left with an amount of only say 94 rupees. So just analyze it. When CRR increases, the lending capacity of the banks will decrease. On the other hand, to control recession, RBI may reduce the rate of CRR. Suppose CRR falls to say 3%. Now, if the NDTL of a bank is say 100 rupees, 3 rupees will go to Reserve Bank of India in the form of reserve, and the bank is left with an amount of only 97 rupees. So when CRR decreases, the lending capacity of the bank will increase. So this is the mechanism of CRR. When CRR rises, just an example, from 4.5% to it increases to 6%, the lending capacity of the banks will decrease from say 95.5% to 94%. And similarly, when I speak about say CRR reducing to say 3% from 4.5%, it goes down to 3%. The lending capacity of the banks will increase from 95.5 to 97 rupees. This is the mechanism of CRR. Now, we all know that on 19th of May 2023, government took a decision to withdraw the 2000 rupee notes which was being circulated in the market. After this announcement was made, people started depositing the money in the banks. Now just imagine the money with the banking sector increased tremendously. In simple words, the liquidity of the banking sector increased tremendously. So now just imagine if the liquidity in the banking sector increases tremendously, what can happen? Banks can lend the money in the market, or I can say banks willingness to lend money in the market actually increases. So it's possible that banks may start even providing loans to many people, which will increase the money supply in the economy. And if the money supply increases, it even results in inflation. Now, If we speak about the numbers from May 19th of May 2023 till 28th of July 2023, it was observed that because of the step taken by the government, that is the step of withdrawing 2000 rupee notes from the economy, the surplus liquidity with the banking sector went up to approximately 10 lakh crores. Now, just imagine if the surplus liquidity with the banks was say 10 lakh crores, just imagine how the banks can lend money, how the money supply can increase, and it can result in inflation. If we speak about inflation, as far as this, when I prepared this video, I had the information about the inflation for the month of June 2023. It was say 4.81%. RBI follows the concept of inflation targeting, wherein the rate of inflation decided by RBI or the target of inflation decided by RBI is 4%. The current rate of inflation is 4.81%. It's above the targeted rate of 4%. Of course, RBI even maintains buffer, or I can say even maintains some amount of margin as a type of buffer. In India, it is said that if inflation is between 2% to 6%, it can be managed by RBI, or it can be managed by the monetary authorities. Inflation going down below 2% and inflation rising above 4% can be dangerous. But still, 4.81% is above the targeted inflation of 4%. So RBI has to control this inflation. And if the money supply increases in the economy, this will not solve the problem of RBI. It will actually worsen the problem of RBI. To control the inflation that can be created due to surplus liquidity in the banking sector, RBI declared incremental CRR from 12th of August 2023. It means it will be implemented from 12th of August 2023. Now, what is this incremental CRR? Here, RBI has made a declaration. It states that incremental CRR of 10% will be applied from say 12th of August 2023. Now, we all know that the general rate of CRR is 4.5%. And RBI has made a declaration of incremental CRR. Now, the duration which has been considered by RBI for incremental CRR is 19th of May 2023 till 28th of July 2023. It means just imagine after the declaration of the withdrawal of 2000 rupee note, many people deposited the money in the banking sector, due to which the demand liabilities and the time liabilities of the banking sector have increased. So logically, the NDTL of the banking sector has increased. So now this incremental CRR will be applicable only in case of the money, or I can say only in case of the NDTL, which was calculated between say 19th of May 2023 and 28th of July 2023. So total CRR maintained will be combination of the normal rate of CRR plus the incremental CRR. I will explain this thing with the help of an example. Let's understand its concept with the help of an example. Suppose till say 19th of May 2023, the NDTL of the banking sector was say 1 lakh rupees. After the declaration of the withdrawal of 2000 rupee notes, let's assume that people they deposit an amount of 4 lakh rupees in the banking sector. So the NDTL of the banking sector will increase to say approximately 5 lakh rupees. And let's assume that the value of NDTL on 20th of July 2023 is 5 lakh rupees. So in this case, if we speak about CRR, the total value of NDTL of the banking sector on 20th of July 2023 was 5 lakh rupees. So RBI will first charge, or I can say the commercial banks, they have to maintain 4.5% of 5 lakh rupees, that is 22,500 rupees with Reserve Bank of India. And the incremental CRR will be applicable only on the amount of 4 lakh rupees. It will not be applicable in case of the entire amount of 5 lakh rupees. It will be applicable only in the incremental deposits. So if we speak about CRR of 10%, incremental CRR of 10%, so 10% of 4 lakh rupees comes to 40,000 rupees. So RBI will actually implement this concept of incremental CRR to control the surplus liquidity in the economy. Because of this incremental CRR, the lending capacity of the banks can actually go down. So the total amount of CRR that is maintained in this example is 62,500 rupees. And RBI has given a hint that the review of this step will be conducted or will be expected on or before, say, September 8th of 2023. So this is only a temporary solution to solve the problem of surplus liquidity in the economy. Now, the most important question, how will it impact the banking sector, or how will it impact the banking sector stocks? It's very simple. Because of incremental CRR, the lending capacity of the banks can decrease. If the lending capacity of the bank decreases, the profitability of the banking sector can decrease for the next few weeks or even for the next few months. So it's possible that people may, rather than buying the shares of the banking sector, they may sell the shares of the banking sector for the next few days. So a downfall or a downtrend is expected in the banking sector because of this declaration. But ultimately, this declaration is for the benefit of the banking sector. Thank you.